Okay, so now we are looking at capital budgeting, which is also called the investment appraisal technique. That is one of the cardinal topics in corporate finance, the company finance, looking at the financing method. So we are looking at the investment appraisal technique or the project evaluation technique. So in the other class, we ended on the internal rate of return for those who attended the afternoon class. Now this time around, okay, we are just building up a little bit, getting down to the other technique. Of course, there are 5 of them, like I mentioned the area. There are 5 techniques that are used in capital budgeting, where we are looking at the net present value, the payback period, the internal rate of return, the accounting rate of return, and the profitability index. So we have 1, we have 2 here. That is the payback. We have number 3, which is the internal rate of return. Then you're getting down to number 4. We have the accounting rate of return. And then number 5, we have the profitability index. All right. So for the criteria that are used here, for this one, acceptance when NPV greater than 0, for those who attended the class, I explained that in the afternoon, but we will still get further for those who missed it. There's no problem. So accept the project with a shorter payback period so that you recover your money faster. Then accept the project when internal rate of return is actually greater than the cost of capital. Okay, so these are the criteria we used for project acceptance. We are doing this topic because you need to look at the project viability as an investor. You want to invest in a project. Is it worthwhile for you to make an investment in a project, or are you going to lose your money? Okay, so all these, so the first one is NPV, which is the net present value, of which I explained the merits and demerits. Of course, for those who missed, there are some notes that will be sent to you. Then accept the project when the PI, profitability index, is actually greater than 1. And then here, when accounting rate of return is greater than cost of capital. Okay, greater than the cost of capital. These are the rules as we look at the project evaluation. So the cost of capital. Now, let us pick it up. We are going to look at the other one where we are looking at now the account rate of return. Some of those who missed these other ones, the net present value calculation of the payback period, internal rate of return, accounting rate of return, we didn't do. So we're going to start with the accounting rate of return. Okay, so we can get to an example to do with all these techniques that are used in capital budgeting. They are independent of each other, meaning that if you missed on net present value, the way it's calculated is calculated in its own way. The payback period is also calculated in its own way. The internal rate of return is also calculated in its own way. Each of these ones are calculated differently. All right, so let us look at an example, getting down to calculating the accounting rate of return. I know we can get back to these other methods like payback period, net present value for those who missed. So let us look at accounting rate of return. Okay, so this is the return that investors expect as a result of making an investment in the project. And there is the rule of acceptance, like I mentioned, accept the project when accounting rate of return is greater than the cost. All right. Okay, so now we are saying accounting rate of return uses accounting profit. Now, this accounting profit is calculated the normal way we are looking at the financial performance of the business, the way we calculate our profit for the year, looking at the income statement, we are getting the profit aspect. All right, so now the accounting rate of return uses accounting profit or losses and not cash flows. The difference between accounting profits and cash flows is accounting profits and losses. So we have to look at the method of depreciation. This is the straight line method. So straight line method will be given in an exam, which is the depreciation equal to initial cost minus the salvage value or residual value divided by the project life. Okay. Now, this is the way we go about accounting rate of return. So we are talking about average accounting profit over average investment. Average accounting profit, that's the formula here. This is a cardinal point as we look at accounting rate of return. It's good for shareholders because they will know that they are going to get their dividends. Okay, for shareholders, you can only get a dividend, which is a profit distributed to shareholders. So the accounting rate of return is good for shareholders because they will know that they will be able to get their dividend. All right, so the formula is average accounting profit you divide by initial investment. So this is the formula for accounting rate of return, which is average accounting profit over average investment. All right, so meaning the formula comes here where you look at sum of profits and losses, then divide by the project life, okay, then divide by initial cost plus salvage value divided by 2. Okay, let's say average. This is average investment. So this one gives us an average investment. All right, now this one is average accounting profit, where we are saying the sum of profits and losses divided by project life. All right, to find the average accounting profit. So the sum of profits and losses divided by project life, if the project has 5 years, okay, the project has 5 years, you divide by 5. Then average investment, you look at the initial cost of an investment where you invested in a building, then plus the salvage value, which is the same as residual value divided by 2. All right, now let us get into, of course, we'll come back to this formula here. Right now, we can look at what are the acceptance rules for accounting rate of return. So here we're saying the company target rate. So accept the project if accounting rate of return is greater than the cost. This is the acceptance of accounting rate of return. Now, advantages, it's easy to calculate. Now, needed information will usually be available. Then it ignores cash flows. It's advantages. It ignores cash flows as they come. It doesn't consider time value of money. So here you simply say no consideration of time value of money. So no consideration of time value of money, which is not good enough because time value of money is cardinal in our day-to-day activities. Okay, so no consideration of TMV, time value. You can even say time value of money. It does not consider a time value of money, which is not good enough. All right. So let us look at a question here so that you understand how you calculate the average accounting rate of return. A company has the following profits from a project over a 5-year period. So we have, this is for 1, 2, 3, 4, 5. So meaning this is year 1. Okay, so this is year 1 here. The second one, $1,500 is year 2. Okay, so this is year 2. Okay, then this is year 1. Then this is year 3. Okay, then this is year 4. then this is year 5. Okay, so these are the profits that are there coming from different years. Okay, so now we have these profits coming from different years. The initial investment is $20,000. That's the initial investment. So meaning that this is how much we pumped in the company. So in the company, we pumped in 20,000 in this investment. In this project, we invested $20,000 in a project. Maybe it can be in a real estate, or maybe in farming, maybe in transport business, maybe when you're doing running as a kitchen run, okay, you have that amount that you invested in. That's a risk appetite, which is amount that you are able to lose if you are to invest, because you may get it back or it may go just like that. Now the company's target rate is 19%, find accounting rate of return. So looking at the formula here, we have to find the average accounting profit. So average accounting profit, these are the profits. So you find the average of these. So meaning that you sum up the profits, then divide by project life, which is 5 years in this case, because of a 5-year period. So we are getting our average profit. You add all these, divide by 5. 5 is the number of years that we have been given in the question. All right, so now we are now to do the average investment. So average investment is equal to initial cost, which is the $20,000, then plus the salvage value. This one is also called the residue value. So in other books, they would say salvage value, okay, or residue, okay, or residue value. You can also call it's also called the scrap value. So there are 3 terminologies that are there as we look at the salvage value. So it is the residue value or the scrap value or the salvage value. So it can be also called the scrap. All right. So now here we haven't been given the salvage value or the scrap value is not there in this question. So you take it, it's a 0. All right. So you take it, it's a 0, scrap value, salvage value. So that's why we're saying initial investment is $20,000. Then, excuse me, then plus the salvage value, which is 0, then divide by 2, which is giving us 10,000. So meaning our accounting rate of return is average profit of 2,180 divided by 10,000, which is giving us 21.8 when we divide 22,180 divided by 10,000, then multiplied by 100. So we're getting 21.8%. So this one is okay because our target was 19% for the company's target accounting rate of return, but we have found 21.8. So it is worthwhile that we can accept this project because it's above our target value of 19%. All right. So the project is acceptable since the accounting rate of return is above the company's target of 19%. All right. This is about.
Sir.
Yes, please.
Sorry to take you back. On average investment, we're dividing through by 2. Where's the 2 coming from? I don't know. I think I might have missed that point.
Okay, so where the 2 is coming from is because we are looking at 2 things that are involved here when finding the average investment. So first and foremost, you need to go for the initial cost. So our initial cost of this project was $20,000, which is given in the question, but we were supposed also to be given the scrap value or the salvage value, which was not given. So this is the 1, 2, these two, initial cost and salvage value. That's where the 2 is coming from as we divide. Now, since the salvage value is not given, that's where this one is a 0. Then the initial cost is 20,000. So these two, the addition of these two, the salvage value and the initial cost, these two, that's where the average of a 2 is coming from.
Oh, so in the formula, it's always divided by 2.
Correct, yes. So from in the formula, like here, it's if you check on this one, the accounting rate of return is equal to the sum of profits and losses divided by project life, which will be stated in the question. If the project life will be 5 years or 4 years or whatever number of years will be stated in the question. So you divide by that number of years that will be given in the question. But for the denominator for the average investment is always the initial cost plus the salvage value. Then you divide by 2. So a 2 is a constant because there are only 2 things that we consider as we look at the average investment.
All right, thank you very much.
All right, so now we get to the okay. So we are now getting down to the actual formula. So now here we are saying the 21.8 is above the target. The company's target accounting rate is 19%. So what we have found actually is above our target. So we can go ahead and accept this project. Otherwise, if we found anything less than 19% target for the company, would have actually rejected the project, meaning that we wouldn't have gone further to invest in this project. So this is about the accounting rate of return. All right, so we can now move an extra mile where we now look at the a question, different question altogether. So this question, we can look at this color question, question 1. Okay, this question is in one of the exam papers. We can look at now. Let's look at this example here where it says Epic, okay, POC is considering, excuse me, considering marketing a new product, okay, with a 4-year life. So meaning that our N here is equal to 4, okay, so meaning our N is 4 years, all right, and then we are now saying Epic we will need to install new equipment to manufacture a product. The picker has to choose between 2 machines, both of which would be suitable. All right, machine 1 costs 460,000 to purchase and install, meaning that this is the initial investment in this machine. We have 2 machines that you need to invest in. Can you go and invest in machine 1, or can you go and invest in machine 2, depending on what we have? So machine 1 costs 460,000 to purchase and install. We have a residual value, which is a scrap value of 20,000 at the end of the 4 years. All right. Machine 2 costs 630,000 to purchase and install, and as a residual value of 30,000 at the end of 4 years. All right. Now, machine 2 takes slightly longer to install and commission, but once in operation, it has slightly lower operating costs per unit and will eventually produce more output. The following projections have been prepared of the cash flows from product sales and operating costs for the 2 machines. All right. So now we have a machine 1, we have the sales and the costs. Okay. Then the company's cost of capital is at 12% per annum. All capital investments have to achieve a payback period of 3 years or less. All right, so that is what we have. But of course, the investment for this machine is 460,000. So this is how much outlay or how much we are making as an investment in this project. All right, so we say this is how much we are able to lose, because as you make an investment, you're not sure about the recovery or if you are going to get back your money. Okay, so this other one is 630,000. This is on machine 2. Okay, so now let us look at the project viability. Is it worthwhile for us to go ahead and make an investment in this project, or in which machine can we invest in? All right, so now using the NPV method and paying attention to the condition set on the payback, do the calculations to show which project should be accepted and advise the management. All right, so this is about this question, 20 marks. All right, so now what is going to happen here is that we need to find the net cash flows, because we have the sales for machine 1 and then the costs for machine 1 we also have. So we are supposed to find the net cash flows from or given or for each year, or net cash flows for each year. We need to actually find for both machines 1 and 2. Okay, so this is our requirement. So among the techniques, NPV is a very, very important technique, and it's a technique that examiners would ask in most cases. It doesn't miss in an exam, so you just need to understand it thoroughly. All right, so now we can go and check out here machine 1. Okay, so we go to machine 1. Okay, we can see that machine 1, the sales are these ones. Okay, so the sales are these ones here. Okay, so we have 1,340,000. The sales for, of course, the investment was negative, because this is how much you are able to lose if we are to invest in that given project. All right, so we have the cash flows for year 1. It is the 180,000. Okay, so 180,000 is how much we have as the net cash flows. All right, so we have 180,000 as the cash flows for year number 1. Okay, year 2, we also have the cash flow, okay, of what we have here. So year 2, we have a cash flow of 200,000, because we are subtracting 1,340,000 minus 1,160,000. When we go back to the problem here, these were rebased. So we have these ones. So this is 1,340,000. So you're subtracting here this one and that one, this one and that one, to get the net cash flows for each year. So for year 1, subtract that one, is the sales minus the costs, so that you find net cash flows for each year. Of course, the investment was 460,000 for machine 1. Similarly, for machine 2, we subtract that one and that one. Each of these ones we are subtracting. This is where the figures are coming from. Okay, so we have that one where we are getting each of these. We are saying, so the net cash flow, year 0, we have 460,000, which is a negative. This is how much money we are able to lose. Okay, then we have the other one. Okay, so meaning here, these are the 4 cash flows that we have. The net cash flows are these ones here. Okay, these are the net cash flows. Of course, there's no need for cumulative, doesn't matter. The examiner may not ask about it, just that is for additional purposes, but it's not supposed to even to be there, but it's just we can add this plus that one to get the next one, this one plus this one, we get -8, this one plus that one, we get the other one, just about that. But this was not even actually necessary to get the cumulative cash flows. Of course, this is what is important, the sales minus costs, then we are getting the net cash flows. Now we discount these at rate of 12%, which has been given in the question. So the 12% is given in the question, we can just look at it. The 12% per annum has been given. So the figure to use for the present value is 1 plus r to the power -n. So this is about what to use, 1 plus r to the power -n. Our rate is 12%, so you can find for year 1. Okay, for the first year, year 0, it's 1. Of course, the number of decimal places doesn't matter. You can go for even the 3 decimal places or 4 decimal places. The examiner can still understand that for as long as the concept is clear. So for the other one, we're getting 0.89. So we multiply this one by the 180,000. So we can multiply 180,000 by 0.89. You're getting 160,200. Of course, it could have been because maybe they changed these to 4 decimal places for this one to be 167.14. All right, so this is what happens. So the 0.89 by 180,000, we are getting this one. Of course, may just would have been rounded off. Then the other one is 200,000. So we multiply the 200,000, then multiply by 0.8. Okay, because this one, the second one is 1 plus r to the power -2 for the other one. So meaning to be 1.12 to the power -2. Okay, so it's 0.79 something. So this is how we are getting these figures here to get the present values. These ones are coming from the multiplication of these ones multiplied by that one to get the other one. This one multiplied by that one to get that one. This one multiplied by that one to get that one. Similarly, this one multiplied by that to get that one. And then the total of all these ones here minus the initial investment, which is 460,000, we are getting the net present value of 24,879. Accept the project if NPV is actually greater than 0. Otherwise, reject the project. All right. Otherwise, reject the project. If the NPV is less than 0, you reject the project, because meaning the project viability is questioned, because you shouldn't lose out. As you make an investment in a building, you should actually get your return, because it shouldn't be meaningless for an investor, for anyone else. This is the reason why we're doing this corporate finance capital budgeting in particular, very cardinal topic, so that you evaluate projects, you can venture into business. So it should pay off as you are making an investment in your business. It should give you a return. So the NPV should not be anything less than 0, meaning you are on the losing side. Whatever you should recover should be more than how much you invested in the given project. So this is machine 1. This is how you have gotten the NPV here, because the question requires that we actually evaluate the machines here based on the net present value. All right, so we have already done machine 1. So we can get down a little bit now to machine 2. So here, to find the present values for each of these years, the net cash flows, we subtract the sales minus the cost of sales, so that we get the value for the net cash flows for each of these years that we have, year 1 through to year 4. All right, so in machine 2, we are also saying these are the cells. Okay, so the cells are these ones. Then minus the cost of sales. Okay, we are these ones. So these are the costs. Then we can get the net cash flows. So this is net. Okay, so you're getting net cash flows where you're getting down to this one. So for these ones here, we can see that okay, we have we have considering the residual value. Residual value, the reason why you're considering it is that for machine one, especially, if we get down to machine one, there was a scrap value of 20,000 at the end of the 4 years. So this scrap value, you should also just account for it, because this is the amount at which you can sell this machine after it has been in use for a number of years. Okay, so it has been in use for a number of years from year 1 through to year 4. Okay, so this residual value, that's why it was considered. As we look at this 20,000, we also multiplied by the discount factor using this formula here. Cost of capital was 12%. So we multiplied by 0.64 to get the present values here. All right. So this is about what this one is all about. So getting down to machine 2, we have the sales minus the costs. So we are getting, are there questions so far? Are there some questions so far? All right, then. If there are no questions, let me proceed. So we look at the sales minus costs. So we are getting that one. The 90 as a net cash flow. You multiply by, we are still using the 1 plus R to the power negative N, the power negative N, which is our rate is 12% in the question. So we have the 12% there. Then substituting that, we getting these discount factors using just this one. N is a number of years, where N is a number of, is representing years. Okay. So if it's 1 year, you put the value there for each of those years. So if it's 1 year, you put 1 there, but it will be, in short, it will be 1.12 to the power negative N, because the rate was 12%. So you can calculate each of these ones using the discount factor. So here you're multiplying this one by that one to get the figure there. The 300,000 by this one to get the figure at the far end. The 360,000 by that to get the other one there. Then the other one here, which is 150,000 by 0.64, we get that figure there. 30,000 by that, we get 19,066. So this is about how we are getting the present values. So our NPV will be the sum of all these, okay? Then minus the initial investment in the project of 630,000. Then we are getting 6149. All right, so our conclusion is that we should invest in machine 2 because it has a higher NPV compared to machine number 1. So here, conclusion, okay, will be, okay, so our conclusion here is that invest, okay, in machine 1, that is invest in machine 2. So here, we're going to say invest in machine 2, so invest in machine 2. Okay, so invest in machine 2 with higher NPV. Okay, invest in machine 2 with higher NPV. All right, so higher NPV than that of machine 1. Higher NPV than machine 1. Okay, so than machine 1. So this is it, the conclusion based on this question. Unless if there are any other questions that people would ask concerning these two machines. All right, so we have looked at the NPV for machine 1 is 24,829. This one is 60,149. So we are to invest in machine 2 with higher NPV. So you select a machine that will give you the highest possible net present value. All right, so this is on this project evaluation technique in terms of the net present value. All right, unless there are any questions concerning this question we've looked at so far.
Yes, I have a question.
Yes.
Okay, I've got two questions. The first one is I want to know how we're calculating the cumulative cash flow. And the other question is maybe I missed it because of network challenges where you were explaining about the residue value of 20,000 in this question.
Is that so?
Yes.
Okay. Okay, so we can start answering any question. We can start either with question 1 or 2 that you have asked. Okay, so the residual value simply means that's a value at which you can sell the machine. When you have gotten your machine 1 was bought at 460,000 kwacha. You install it, you put it, you purchase and install it at home. Then you know after 4 years, you can only sell it at 20,000. That's what it means by a residual value, which is a scrap value. So meaning that 20,000 will be your benefit from the amount that you bought that item. So besides how much money that machine will be giving you, if it's the printer or any machine, okay, year 1, it is able to generate the net cash flow of the difference between the sales and the cost. Of course, that will be your benefit. And then year 2 also, you will be able to get like here, we have the benefit for machine 1 of the sales, which is 1,340,000. And then minus the cost, we are getting the net cash flows. So these ones are net. Okay, so this is the net cash flow. Then you have up to year 4, but of course you also have the residual value for year 4 of this 20,000. So you don't have to let it go, it's your money. But all you need to do, you need to find the present value of it using a discount factor or at year 4, which is 0.64. Of course, you need to calculate this when finding the present value factor, which is the PV, so present value factor using the formula, which is this one, or you can even use the financial tables. All right, so this is about how you get using 1 plus R. So R is a 12% in this case. So this is how discount factors we are obtained. So multiplying the net cash flows by the discount factors, we are getting the last column for the present values. So this 20,000, we have accounted for it because we cannot throw this money. This money is our benefit because we still have it, meaning that after you have used that machine or your vehicle for 4 years, but you can still, even if you acquired it at 460,000, but you can still sell it at 20,000. Excuse me, is that clear? Is that clear?
Yes, it is.
Yeah. So you are accounting for 20,000. That's your money, but you need to just find the present value of it, which is by multiplying by the discount factor to get the present value. Looking at the last column there, All right, so that I think I've explained the scrap value. This residue value is also called the scrap value or salvage value. So this one has three terms: residue or scrap value, all right, or salvage value. The three terminologies. All right, so now we have this, I've gotten it. So meaning as we go, I'm going to explain to you the cumulative cash flows that you asked, but same as machine 2, you also need to do the same. The salvage value was 30,000, which we should account for, that you don't have to let go of it because it's part of your return that you should consider. All right, so we multiply by each of these to get to present values and get an NPV. So here we're accepting the project with a higher NPV, which is machine 2. Now, getting the cumulative cash flows, we are simply saying the first one is negative 460,000 because it's negative. The reason is that that money is you are able to lose. You are likely to lose. That's why it's a minus. A plus means what is coming to you. A minus is something that is going away from you. So negative 460,000. Then you start cumulating. Cumulative simply means adding these. So negative 460,000, then plus 180,000. All right, it's giving us negative 280,000. So this is where this one is coming from. So a cumulative, you get negative 460,000 plus the actual cash flow that has come. All right, which is the 180,000. The minus, which is 1,340,000 minus 1,160,000. 1,160,000. You're getting 180,000. So we're adding these. So negative 280,000 plus 200,000, you're getting negative 80,000. Negative 80,000 plus 160,000. I'm sure you're getting it, not so. Is that clear?
Yes, yes.
So this is how you're getting these. So this minus, because it went away, plus what came in, we are getting negative 280,000. This one plus what came in, we're getting this one. This one plus what came in, we're getting, and then just like about that. But we don't, this is just for the sake of presentation, but the examiner may not even consider it that much. What is interested in is to find the present value. So you use the net cash flows, you multiply by the discount factor, and then you get the present value. So for both of these machines, this is how it was done. So even here is negative 630,000 plus 90,000, negative 540, plus 300,000, negative 240, plus 360,000, it gives us a positive 120, just about that. Is that clear?
Yes.
All right, then. So I've explained this question, so we just have time to go through it. Unless
Sir,
yes.
Sir, which figures are you multiplying to get the present values? Is it the cash flows or the cumulative cash flows? We
are getting the net cash flow, just the net cash flow, the cash flows, not the cumulative. We don't use the cumulative. Cumulative was just the aspect of presentation, but don't use it. We use the net cash flows to multiply by the discount factor to get the present values, please. All right.
Okay.
So yeah, so we end the class for now. So the other class that we are going to have, I think Mr. Collins is going to actually advise on the time that we are going to have another class.
Okay, so kindly requesting for the video because some of us missed the afternoon class.
Okay, that one I think it will be shared. No problem. No worries about that. To be shared. If there are any other questions, we'll still have to have another class so that for those who missed it, you can still run through so that you can understand this topic thoroughly, so that at least you get ready for your tests and exams. You can end the class for now.